5 is the second session, and then 11 o'clock is the third session. This is more interactive. If you have questions, stop me at any point in time, ask. I'm here to give you an investment philosophy that I learned and actually saved my career. I've been in the investment business since 1985. I've been through 3 market crashes. The first 2 I crashed and burned along with everybody else. The third one, I looked like a hero in 2008. We were actually positive in 2008. We did not own any equities whatsoever. This philosophy I'm going to teach you this morning, you can do yourself if you so choose to. If you want a book on it, I will send you a book that was written by a guy named Thomas Dorsey. I will send you a book. It's a PDF file of a different book called The 3-Point Reversal System. It was written by A.W. Cohen back in 1948. And it's very simplistic. It's very short, sweet, to the point. What I want you guys to think of, I have internet access here. As I go through this, I'll go through the formal part pretty quick because I want to get your ideas and your views. If you have any stocks that you're thinking of that you own, we'll analyze them live right now as we're sitting here to give you a flavor for how this works. Does that sound good for everybody? And if you have questions, please stop me. As I mentioned, I'm Roger Balser. I own a firm called Balser Wealth Management. I was fired by a guy way back in 2000. Best move of my life. Thought it was horrific. Became the best move of my life because I was able to go out and start my own brokerage firm, my own investment firm. With that, the things you're going to hear today, I guarantee you have never, ever heard an investment advisor talk about before. And when you go back to your investment advisor, which I would highly, highly, highly recommend, ask him, what are you doing to save my portfolio? Because has anybody ever heard of the pie chart? Seen the pie chart idea? It doesn't work. It doesn't work. It's like I'm going to the Kentucky Derby next week, and what they're going to do is shoot the horse that wins the Kentucky Derby, and not let him run in the Belmont. That's what they call the asset allocation. You sell the bad and buy more, or you sell the good and buy more of the bad. Our philosophy is you don't own the bad in the first place, and when you own the good, you keep buying more of the good. This is an idea of this philosophy was called point and figure charting. I'm going to tell you what it is, how it works, and whether or not we are in a bull or bear market right now. And then I'm going to give you a caveat about tomorrow, or on Saturday, where there's a speaker, which is tomorrow, which is the economist whose brother was out here in September. And I want somebody in the room to ask that exact question to this guy that I give to you, because I can't ask it. Point and figure charting was actually started by a guy named Charles Dow, way back in the early 1900s. It was started by Charles Dow. He was first publisher of the Wall Street Journal. That's a picture of him over there. He created what's called the Dow Jones Industrial Average. Charles Dow was actually a fundamentalist at heart. What a fundamentalist is, that's when you watch on CNBC and somebody will sit back and say, we see the earnings are going to be this going forward. We like the management. We think this is happening. Ours has nothing to do with that. What Charles Dow would sit back and see, though, he started to see different patterns forming. And he started to see things that were moving in the marketplace. And what he wanted to do was develop a philosophy of trading or investing in the market. This part right here, we have a slight problem. This philosophy, when I told you, is very, very, very simplistic. It's all based on supply and demand. Supply and demand. All of you guys in here sell something, right? You can have the greatest product in the world, but if there's no demand, it doesn't work. In this slide here, the guy's actually calling his boss and we have a slight problem. We have a lot of supply, we have no demand. We take this philosophy all the way down in a simplistic form to say, is the market being controlled by supply or demand? Are investments being controlled by supply or demand? If they're controlled by supply, guess what's going to happen to the price? It's going to go down. If it's controlled by demand, the price is going to go up. That's how we're going to be able to analyze these stocks for you that you're going to throw out to me later on without even knowing who the company is, knowing who the management is. I don't even know 99% of the time what sector it's in because it doesn't matter. And that may sound alarming to some of you there. This is the original point and figure chart that Charles Dow developed. To take a look at it, can you tell me which way this chart's going? Is it controlled by supply or demand, do you think? Demand. Controlled by demand. Well, what's the problem with this chart? The problem with this chart is Charles Dow would write these numbers, and then he'd flip over, But you really don't know if you get up to the top where 64, 63, 62, we don't know whether it's pushing up or whether it's pushing down. What Charles Dow would do when he would develop this, and he actually would put it on a piece of graph paper, which you can do, which I do daily. I chart over 500 stocks each and every day, and it takes me about 30 minutes after the market closes. You can do the exact same thing. I can show you the chart paper. I can teach you exactly how to do it. If you so choose to do that, it's just a phone call. But what Charles would do is he would buy a stock. Let's say it's XYZ stock. He'd buy it at 38. It would go to 39. It would go to 40, 41, 42, 45. And it was only the closing prices. All the stuff that happens during the day, unless you're a day trader, which I would highly discourage. But everything that happens, we do after the market closes. I can't tell you where the market's going to open right now, and I really don't care. What matters to me is where the market closes, such as Jim found out where the market closes. Right? But then what would happen is Charles would change over and go down 41, 40, 39, change columns again and move. I will show you exactly why he changed the columns. This is what the point and figure chart looks like now. That's actually a chart of Apple previously to the split. And this chart actually is from January. Point and figure basics, when you have an X, and if you go back to where we just had the numbers, it's kind of hard to figure out which is in control or not. Take a look at this. They changed this in 1920, and it hasn't changed ever since. They put an X means that the price is rising, which means demand is in control. The O's mean that price is falling, which means supply is in control. Very, very simplistic, X's and O's. You can look at this chart, and I've taught this philosophy to kids in 4th, 5th, and 6th grade, and they get it. My daughter's team, she's a junior in high school, her team right now is winning in the Cleveland area with the stocks, and they don't have a clue about what stocks they own. They only use point figure charting methodology that I taught them over a weekend. Those of us in this room may take a little bit longer because kids pick up on it very, very quickly. We alternate columns of X's and O's. Key point here, it's a minimum of 3 X's or O's in a column. That's called the 3-point reversal that A.W. Cohen put into the philosophy way back in 1948. The reason for that is it stops the whipsaws. So you can have a stock, let's take Apple, let's say we're sitting right here, we're at $420 a share, demand is in control, and all of a sudden, Apple goes from 420, 410, or 410 and a half, never quite hits 410. Goes back up 419, comes back down, hits 400, goes back up, comes all the way down, hits 390, still don't do anything. All of a sudden it hits 380, we put in 3 O's, we now know that demand or supply is in control. You may want to take a look at the stock and see where it's going. So, sir.
Are you going to get to it, or what's on the x-axis?
We can get to that. That's great. What we have on the left-hand side here, these are the prices of the stock. These on the bottom are the years. So we can actually take a chart, a stock. There's candlestick charts, there are line charts, and the point and figure charts. You've seen the squiggly line charts? Those stock, it takes you almost for an entire year, the Dow Jones Industrial Average, you probably go from this side of the wall to the next room. We can take a point and figure chart, and by only using the closing prices, we can shorten it down and be able to look at the chart and read it. So the numbers are put, or the years are put on the bottom. I can pull one up for you, give you an idea of where the market is. This is the philosophy that I go through every single day when I chart stocks. Very simplistic. Charts following the column of O's, we check the daily low. We say, did it fall? The answer is no. We ask then, did the stock reverse up on its chart? How many points would it have to reverse up? 3 points in order for us to do that. Let's say, yes, it did. We then move over a column, move up 1 box, put the 3 X's on whatever price it was. If it went up 10 points, we would put 10 X's. Make sense to everybody? In the appropriate place. Then if it's yes, we then move on to the next chart. Let's say it's no. We do absolutely nothing. You just don't do anything. So a lot of the noise that the stock's going up and down and moving really doesn't matter. What we're looking at is the 3-point reversal on that. These are 2 different patterns that are very, very, very important and point figure charting or technical analysis of what they say. One's called the double top on the left, and on the right is the double bottom. As we just went through it, we'll take the double top. Let's say we have a stock at 39 and it drops all the way to 31. We go through our flow chart, and let's say it's yesterday. We take a look at it and we say, okay, did the stock drop to 30? No, it did not. Did the stock move up to 34? The answer was yes. Change columns, put 3 X's. And then we flip the chart over, close the book, go to the next one. So, sir?
Yeah, are those prices per day then? Or
we take the closing price. So whatever the stock is that day.
does 10 represent the closing day?
Where we start, let's take 39. We'll
Okay.
flip through it. Let's say we have a stock right now that's 39. Let's just say it's IBM.
That was a
Throw
closing
that out.
day.
Let's say it closed January 1st at 39.
Okay.
And then all the way through January, it went from 39 and went up to 40, never actually hit 43, 42 area, never hit that, just stayed at 39. And then all of a sudden, February 1st, earnings came on IBM, and all of a sudden, IBM goes from 39 to 36. Well, we would go through our column, put the zeros down. Now, the days have no meaning to it. That's just on the bottom to give us an idea on where we're going and what's happening when you look at a chart. Does that make sense to answer your question? So it's not, we look at only the closing prices. And then on the right-hand side is the double bottom. As you can see, the X, demand's in control now, or supplies was in control, demand took over. That would be a buy signal. We would then start buying the stock right there. And then here, if you own it, you sell it. So we're able, and I'll show you as I get through a few ideas. Yeah, Joe?
What you're saying is it doesn't matter. Time across the bottom is irrelevant.
Is irrelevant.
It's just when it makes that change.
Makes that change, you make a move.
So you could have 15 columns in a year, or you could have 3 columns in a year.
Correct. So it just all depends on the movement, on the volatility of the stock.
So
And
right
in doing
now, your
this,
charts are wrong.
pardon me?
So right now, your charts are wrong.
Actually, most of the charts that we have, when I'll show you a few as we go through this, most of them are so short and it's amazing.
You don't have this current market that's dropping and swinging like it is.
Depending on what is happening with each individual stock. I mean, I'll give you an example of one. This is what I call pay attention. This is total housing starts. We actually chart housing starts, which may sound like a strange thing, but we take a lot of different economic data that's out there and we chart it because we want to be prepared for what is happening. And if you look at this actually goes from 1976 all the way through 2013. So that's a chart from 76 through 2013, and that is based upon the total housing starts in the United States. And this was one area that my clients, the ones that I had in 2010, 2011, will never, ever, 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 ever leave me. And when I show you exactly what transpired, you're going to probably go, come on. We took a look at this chart, and in June, or in April of 2006, we noticed it went to a sell signal on housing starts. That was kind of alarming because if you take a look, going all the way back from 1990, basically the trend was up as you're going up on that. And in April of 2006, we noticed something was happening. We did not have any clue that the market crash was coming. We did not know housing prices were going to fall through the floor. We did not know that. Nobody knew that. If anybody tells you they did, go on. Very point blank. But what happened is all the way down, crashed and boom, all the way down 07 to 09, dropped all the way down to housing starts down to 491,000 from being way up. And then what transpired is June of 2009, you see the little circle we have here, June of 2009, we had a buy signal. First buy signal is usually false, so we kind of wait. It's kind of giving us a little tease. You can take a little small position, 10, 15, 20% of it, and wait for the second buy signal, which we did in November of 2011. Well, we continued to chart this and continued to keep an eye on it. Currently, housing starts have started to fall down. They just came out with an announcement. As I was on the plane, I was talking with a gentleman. It was down 14.5% on housing starts. we purchased what's called the ITB, which is an iShare of the housing market. We purchased that, and this is actually the chart. To answer your question, sir, chart from 2009 through 2013. That's the size. It's on an 8.5 by 11 sheet of paper. We purchased it on November 18th of 2011, held it till July 25th of 2013. There's the buy signal that happened here. Sell signal happened up here, up 112.05%. S&P is respectable, 39%. Would you like to have had that in your portfolio? The only problem was I didn't buy enough. I did not buy enough. But that kind of a concept, those are things, and during all of this period of time, you have all the pundits on CNBC, Fox Business News, CNN saying stay away from housing. Stay away from housing. And we're buying into it because there's a buy signal. These are unemotional indicators. We are not emotionally doing any type of investing. You can, and as you'll see, we'll pull up a stock, don't have a clue what it is, don't have a clue what sector it's in, but we can analyze it for you. Quick quiz, supply, demand, and control. Anybody? All right, Jim, already paid you once. Supply, demand, and control.
Supply.
Got it. Exactly. Right here's your signal on the way down. One quick thing on these that I forgot. Where you have the 1s, 2s, and the 4s, those are the months of the year, just to give us a flavor when that happened. And then you have A, Bs, and Cs that are for October, November, and December.
What did you say the numbers represented? Like 3, 4?
Right, if you take a look here, that's January. That's when it made the change, and it doesn't say the date, it just says the month. And I mean, we can actually pull that up, and it'll show on my chart exactly where it came from.
And the ABC?
The ABC, we go through the first 9 months, then we hit. The A is for October, November, December. So it was ABC. Question I'm always asked, what's the S&P doing? If any of you have read any of the articles that we published in Agency Sales Magazine, I'm going to give you a quick thumbnail. This is actually a conversation that Steve Corcoran and I had on his 401k. Go back and read this article. It's called 2 Beers and a Napkin in a 401k. And I actually had explained to Steve, who's in the back of the room, how to manage his 401k just using the S&P 500. When I ask is, they say, what's the S&P doing? I say, which S&P? They go, what are you talking about? Does anybody know there's 2 S&P 500s? No?
No.
When you go back, ask your advisor what S&P 500 he's using. And when he gives you this blank look and goes, well, there's only one, say, no. There's 2. They own the exact same 500 stocks. But the key caveat is they own them in different percentages. One is called equal weighted, one is called cap weighted. The one you hear about on TV every day is the cap weighted index. Somewhat like Congress. You take anybody here from California? You guys have the greatest representation because you have the most amount of people, right? Anybody here from Rhode Island? Wyoming? Yeah, their representation is very small. So if you take a look at this, their weighting in the House is about 12.8%. Take a look at Wyoming's 0.23. Weighting in the Senate is equal. The equal weighted index is like the Senate. You have equal votes, equal representation. If your advisor's not using this, he's doing you a major disservice. To give you a second example, to kind of put it in with the S&P, if Apple moves in the S&P, has bad earnings, good earnings, moves it, it's about 3% of the index. Paradigm is 0.02. In the equal weighted index, each one is 0.2. Does everybody get this part? Does it make sense? No? Yeah. You have 2 indexes. One is cap weighted. We call it Congress. The other one is equal weighted. We call it the Senate. Doesn't matter how many people we have, everybody gets the same amount of votes. Very important. This is a hypothetical growth, and I have to say hypothetical because the SEC tells me to. My clients actually perform this. This is usually 1/3 of our portfolio when we do this for the accounts that I manage. This goes through April 14th of this year. And if you owned just the S&P, you'd be up 24.59%. Just by making this one simple change, just one change, by knowing which S&P index to own, you'd be up 152%. Is that important to know? Is that important for your advisor to know?
Why would he not be interested in having us in the cap weighted?
He should be interested in having the cap weighted. The problem is, he doesn't know. Most advisors, if you ask them, and I highly recommend this, if you ask your advisor, what S&P index do you use? I will bet you $100 almost every single time that he's going to say, well, it's the S&P 500. And then press him on, which one do you own? And when he goes, what's the S&P? Say, no, wait a minute, let me educate you. There are two S&P 500s. And if you go back to the article that was written, you can pull that article out and set it right in front of you. And if you need a copy of the article, let me know. Shoot me your email or give me your card and I will send it out to you. We just did it, was it last month? And we also had in the article again last month, the S&P 500 comparison. Because this is the bedrock, folks. And if you know that, it could make a dramatic change in your portfolios. Dramatic change. Sir?
They both, like, did newspapers publish the second one?
They publish it, and it's called SPEWI, the Equal Weighted Index. Or there's a what's called an iShare, which is an iShare is a mutual fund that's traded as a stock, and it's called RSP. It's by a company called Guggenheim, but the symbol is RSP. And so if you look at that one versus the S&P, you'll see a big change. When this actually happened, it happened in 2001, when that change happened. Going from 82 all the way to 2000, it was the cap weighting. And when the equal weighted change happened, we made a move. And it was a alarming move. And believe me, folks, it is, when I sit down and talk to groups, and they go back to their advisor, and their advisor doesn't know this is a bold statement, but you fire that person, because they're singing from the hymn book, and all they give a damn about is a brokerage firm. They don't care about you and your portfolio. And where I told you in the beginning, when you walk out of here, you will know more than 99% of the advisors out there. And I guarantee you this is it. Now, there are some pros that are out there that understand this. Those are the ones you want to work with. Sir?
Is there a reason why the equal weighted outperforms, or is it just a historic trend that you noticed and therefore you balanced that?
Duncan, I should have paid you the $100.
Wait a
It's a trend. It's trend following is basically what we're doing. We do not sit back and ask why, because in the whole scheme of things, it doesn't matter why. We find out later on. We did not know when housing, if we can go back to that very quickly, when housing fell through the floor in 2006, we didn't know why. We just knew it was happening and we acted upon it. The why comes later. I mean, we can do theories on it, but I'm not very good at that. Big part of our portfolio management system is called relative strength. Basically what relative strength is, all major sports teams have it, World Golf has it, the BCS standings used to have it, they're going to change it coming up here. Tennis has it. It's a simple calculation. It's a very, very simple calculation. We use this a lot, and I'll show you very quickly in the process. We use it when people will say, first question you need to ask yourself if you own something is it outperforming the S&P? Not the S&P cap weighted. Is it outperforming the S&P equal weighted? Because if you're outperforming the cap weighted, there's a whole difference in there. You still could be losing money. You should just own the cap weight or the equal weighted then. So it's a simple calculation. It's the stock price times 100 divided by the index gives us our relative strength rating. We multiply that by 100 to give us a number big enough to plot on a point figure chart. Same things come in, the buys and the sells, the double tops, the double bottoms. You can have quadruple tops, quadruple bottoms. Just tells you it's stronger. But that's parts that really you don't need to be in. The question again, in reading it, tells you whether you want to be in that or not. You want the best of the best. You want the all-stars. Very simplistic. You want the all-stars. You don't want the guy at the end of the bench. You want the top 5 all-stars. That's what we're able to do with relative strength. Does that part make sense to everybody? I'm trying to go through this so I can get to the good parts. I'm going to go back to the S&P. And this is an example going back from where you had mentioned, sir. This is going from 94 to 2011. That's the chart. So it's basically 3 columns. When relative strength speaks to us, it doesn't speak often on a buy or sell signal because the signals usually last anywhere from 18 months to 24 months. So they're not quick signals. So when they basically light our eyes up, we make sure we take a look at them when we do the research into it. But this gives you an example on how repackaging the S&P. From 94 to 2000, the signal was in a column of O's, which basically means you should have owned the S&P. SPY is the symbol for the cap-weighted index. You should own the cap-weighted index. Change happened, came over into a buy signal, and that actually happened in May of 2000. From May of 2000 through October of 2008, you should have been in the RSP. Yes, it did not guarantee a win. It was down 0.79, but it was a lot better than being in the cap-weighted index, down 33%. 23rd of October. Pretty alarming, isn't it? A lot of things were happening in 2008. Change columns again, all the way up here. You would have gone into the SPY. This shows you an example where it doesn't always work. Does not always work, because at that point in time, we were in the cap-weighted index, and we lost more money. So it doesn't work every single time. On April 16th of 2009, up through today, you should have been in the equal weighted index. You'd have been up 169% versus 120. If you would have just bought and held through the process, which is what most people tell you to do. I happen to not be a believer in buying and holding. I'm going to shoot the dead horses in last place in the Kentucky Derby because I'm betting on the top 3 because they're going to come back and win in the Preakness and in the Belmont. If you bought and hold the SPY, which is the S&P cap weighted, you have 298%. Buying and holding the S&P equal weighted index, you'd be at 476. By knowing which one of those 2 to own, from that period of time, you've been up over almost 600%. A difference of 132% more than just buying and holding. Would that help your portfolio? We actually do that. It's called the people's portfolio. Because it's for the people. And I'm not running for Congress. To give you an example, I took this from 94 all the way through today. It's a money market account. S&P, which is the house, which is which index? Anybody? Cap weighted, great. S&P in the Senate, doing the switching, and doing the people's portfolio. And what that is we actually bring in the money market account on the people's portfolio. So we have just 3 different actors in this play. We have the S&P cap weighted, the S&P equal weighted, and the money market account. And by doing that, you'd be up 762%. So there are times when you should not be in the market at all. And I'll show you an example coming up here in 2008 how we were not. This is an area where I mentioned the relative strength. What we do is, it's called DALI. We take 6 different asset classes. And DALI stands for Dynamic Asset Level Investing. We take the world index, we take commodities, currencies, money market account, fixed income, and the U.S. market, and the international markets. We have 6 areas that we take. We have a wrestling match between them, or we have an arm wrestling match. Take everybody in this room, to give you an example how this would work, is every person in this room would sit down in a table on one side and the other. We'd have an arm wrestling match. And then we would go through after the first round and we'd say, okay, Matthew, you won. Kurt, you lost. Dan, you won. We put a check mark down. Then everybody would do it again. And at the end, what we do is we tally up the number of wins. That's our strongest player. And we just rank them from top to bottom. And then what we do is we buy the top players. It's that simple. I do this with 401ks every single day. I actually had Steve's 401k, his wife's 401k. We took it over last May. It's up 38%. Not too bad, considering where the market is. Give you the guidance on Valley and how this works. This is actually what the market told us. Once we figure out the tally system between the 5 indexes, we run them against money market, because as I said, there's times to be in the money market account, times to be out of the market. If it doesn't outperform money market, we're in money market. If one of the 2 indexes does, we then concentrate on those 2 asset classes. Make sense? Going all the way back to 2008, this is the important part. 2008, on January 4th, we own money market commodities. When I say commodities, it's not the soybeans, so where they're going to drop them on. We're not playing the commodities market. We actually purchase the indexes. And we can do the ranking system in each individual index. On March 12th, foreign currencies kicked money market out, so we had foreign currencies and commodities. July 23rd, commodities were kicked out, and foreign currencies stayed in the portfolio. Excuse me, guess what happened in August of 2008 to the commodities market? It fell off the cliff. It went straight south. We did not know that was happening, but the relative strength calculation told us to make a move. We moved out of it. On October 1st, we owned only money markets. Only the money markets. We did not know that the crash was coming. We did not know that. Can't specify that we did not know that. We were just following the process. It's all an unemotional process. And then take it through, on the 22nd, we moved into fixed income, take it all the way down to where we are today. And this changed on September 8, 2009, we're in international equities and domestic equities. So the entire year of 2008, starting on January 4th, we did not own any equities whatsoever. Pretty alarming. Do you think your portfolio could have possibly been saved in this kind of a concept? Now to go and give you a longer chart. This is actually a chart of the S&P 500. This is the cap-weighted index to show you the different changes that have happened. And this is a chart from 2000 to 2009. Key part I want you to notice here is from 2000 to 2003, which is the red part where the market was actually taking a breather, which is a nice way to say it was going down. Fixed income was in one of our top 2 asset classes for about 845 days. International equities and foreign currencies weren't even on the map at that time. Well, from June of 2003 through January 2008, international equities and commodities held the top 2 positions for the majority of the time. If you weren't in international equities at that time, you weren't on the sweet spot. It's kind of like if anybody's golfing here, you know when you hit that ball on the sweet spot, international equities was the sweet spot. And going through that up here, as I just mentioned, international equities fell out, money market in, commodities out, money market in. Both top 2 positions right here. Fixed income went in, and then international equities went in January. Kind of get a flavor. I'm feeling like I'm losing it. Is all this making sense, or is it kind of too much? Yeah. We actually do this. This is an example. I'm sorry for it, but this is actually an example. We follow 40 different sectors of the market, and we cross-section them out in 40 different areas. What I wanted to do to put this up for you is the B's and the X's mean they're on buy signals. The S's and the O's and the S's and the X's mean they're on sell signals. This gives you an example of the 40 different, and I brought it down to 30, but it's 40 different sectors that we follow. This is a matrix that we bring up, where I said we did the wrestling match or the arm wrestling. This is how we figure out who's in the top positions. If we wanted to look at the top 5 sectors, we go up to the aerospace industry, biomedical, building, textiles, and the medical industry. That's where we would start our exploration if we were just looking at the sectors. So if you see a matrix like this, if you want us to do something with your 401k plan, you'll see this kind of a matrix. And what we do is we take your options in your 401k plan, put them through the process, have the wrestling match with each one of them. We then do a video for you, send the video out to you, and say, this is where you need to concentrate on. These are the securities you need to own in your 401k plan. And if a change happens, we then contact you back and say you need to make a change. So you're not messing with your 401k on a daily basis. It's in our process and it's done automatically every single day. Sorry.
Does this company work, our 401k, we're very limited as to what we can do.
You can have 4 options and it'll work.
You know? I think we've got 15 options, and that's it.
It'll work. We did this same presentation to a MOFSI down in January in Florida. I had a gentleman call me from Texas 3 weeks ago. He said, my wife has a 401k plan. We have no clue what we're doing. There's X amount of dollars. Can you help? I said, send me the options. And it's just the menu of the options that you have. So you said you have 15 available. Send those over to us. We will put them into the process, put the S&P 500 in there, put the S&P equal and the money market, run the process. And then we'll tell you, here's what you need done. And it's run every single day. If you're in Hawaii, you're in Austin, Texas next year for the meeting, that portfolio, they're being run tonight. Everything will be run. And the calculations that are run are astronomical with the firepower that we have and the computer power. And then when the alarm comes out, shoots me an email, I need to take a look at Duncan's 401k plan with ABC Corporation. There's a change that needs to happen. I then contact you, or with a lot of our clients, we actually have their passwords. We go on the web and we make the change for you. A lot of the work is done in sectors. This is an example of a buy and hold strategy, perfect market timing, buying the best sector and buying the worst sector. Going back from 93, flip through this quickly. Buy and hold, you had about 7.12%. Buying the worst, you'd be down 10.8. Buying the best, you'd be up 30. Perfect market timing is 26. So this is not timing the market. A lot of people, aren't you timing the market? Absolutely, unequivocally, no. What we are doing is buying the best of the best on the day in which it becomes the best, and we're holding it until it starts to turn down. Make sense? We are in a structural bull market. Yes, sir. No.
Do PE ratios follow your charts as well? I mean,
Some do, some don't. Give you an example, which I used to have a chart in here. GE. GE had earnings that were going straight through the roof. Stock went straight down. PE has nothing to do with it, in my opinion. I think all those guys that they paid millions of dollars on Wall Street are wasting the money. Because it's all about when you whittle everything down to it. It's supply and demand. More buyers and sellers, the market goes up. More sellers and buyers, the market goes down. Buying and selling are equal, price stays the same. There's nothing else. It's Econ 101. Now, are there reasons that it happens? Absolutely, there are reasons that it happens. Is it PEs? Is it missing earnings? That does happen, but when you really boil it all down, it's economics 101. It's that simple. I told you, I'm an ex-football player. I'm not the brightest tack in the woodshed. But this works, and our clients make money. And we get them out of the way of the freight train that's coming. So all the stuff that you see on CNBC, Dennis Gartman's always on CNBC, and he's telling you one day to buy corn, the next day he's telling you short corn, he's telling you to buy gold, 2 days later he's telling you to short gold. Well, wait, tell me what you're doing. Is it going up or is it going down? I want a trend. And when it changes, I want you to let me know. To give you an example, this goes all the way back to 1986. It takes it all the way through. So it gives you the different bull markets, bear markets, bull markets, bear markets. We decided in 2009 we were in what was called a structural bull market. Gentleman that's speaking on tomorrow, he's looking for a 15 to 30% correction. Said this in September, and said between 6 to 9 months. Well, my calculations are correct. He better have a big 30% correction coming, and he guaranteed it. I flipped the chart up next, showed the market's going straight up. I said it's a trend. I don't forecast. I do not have a clue where the market's going, and neither does anybody else. Nobody knows where the market's going. The market does what the market does. We just look at the closing prices on supply and demand to tell you where we think they're going. Sound good to everybody? Everybody get this?
And that's one of your asset classes, equities, right?
No, this is just the S&P.
Right.
That's the Dow Jones Industrial Average. U.S. equities are the #1 asset class right now. #1 asset class. Have been for a long time. since 2009.
That was for 2013.
Right, that's just the chart going up. And it took it through 2012 on the top. That's just giving you the change that happened with the S&P. Because when I do these, I can change that every other day when the market changes.
No, I get that.
Okay. I'm going to flip through these because I want to. This one's fun. Everybody follows and has an idea where we're going and what we're talking about on this. Dan is one of my partners that works with me. And this is actually the chart site that we do. Give me a stock of somebody else.
3D systems.
3E?
Yeah, 3D.
3D? Do you know the symbol on it?
Huh?
You know the stock symbol?
DDD.
This is always the risky part. All this up top does not matter. Earnings are coming out. Came out 29th. That's your stock. As you see it, this is going to be right on here. That's going to be 2013. So if we take a look at this stock right now, take it down a little bit. Take a look at this stock right now. It is still in a downtrend. Stock sitting what, around 52 right now?
Something like that.
Take a look at it around 52. Take a look at the stock. Let's go all the way back to the front. All the way back. Take a look at the stock. Let's take a look at it right here in January, or in 2013. Nice uptrend. Stock looks good. Should own it. Looks very good. Should own the stock. All of a sudden, start to see some supply come in here, right? Goes back up, hits the top. This is what's called a resistance line. So to bump up against a resistance line, may do it once, may do it twice. If it breaks through, it's good. If it doesn't break through and comes back down, that's not good. So if you take a look at this stock, best piece of advice anybody could have given to you, sell it right here. Okay? Guess what they did because they like you? They said you should have sold it here and you didn't. Gave you another chance to sell it at a higher price. Then all of a sudden, it comes back down. See the column of those? Goes back up, boom, right through the floor. Then all of a sudden, buying pressure and the day traders come in, it goes up, right back through the floor. If you were holding this stock for a long period of time, let's say you bought it way back in the 20s, and I'm just making this part up because I don't have the chart going that far back now. When it broke through this resistance line right here at 74, that is a warning. That is a pointing light. It's saying get out, get out, get out, get out. The fighters here, get out. Get out now. All that time in between, from the 97 range down, is the noise that's happening. But that tells you right there, that's your floor. Hits there, get out.
Can you pull up this competition now?
Sure.
That shows. SSYS.
Mind you folks, I know nothing about these companies. A lot of movement in this stock. But take a look at this stock. Let's say we bought it right here at 112. Stock looks good, continued up. Could have lightened up here if you wanted, but never hit our resistance levels. So we're good on it. Once again, we own it here at 112. Here's your sell signal, right there at 112. If you wanted to work on this, say you bought it here, you bought a nice little portion. Let's say you bought 50%. You had 100,000, put 50,000 in. Bought another 50,000 here. That's your double top buy signal. Triple top. Stock's looking very good. All of a sudden it drops down. Could have sold out a little bit here. I probably would have held it. Comes up to here. Here's your sell signal. Bam, you're out at 126. So you make $14 a share, made a little over 10%.
Can you do this with a mutual fund?
Give me a symbol.
I don't know the symbol that says SIT small cap. In other words, SIT, SIT out of it's a small cap one.
I see if you can get on the web and pull that symbol up. What I say. Let me throw one up here for you that I find it with. Trying to bring up the good old This is one that it's in actually most people's portfolios. It's Bill Gross's PIMCO Total Return Fund that is there. And that gives you some more example. People are often not saying you shouldn't own bonds. I'm not a big believer in bonds, but if you happen to own them in this, still on a buy signal, looking fabulous. So I just throw that one out.
Sorry, can you do GPC?
Hopefully, is this helpful to you guys? To give you an idea? I mean, because I know, I do not have a clue any of these stocks are. And it shows you can analyze it and not even know. Genuine Parts Company, monthly momentum, what's in there? That's on a monthly basis, which tells you on a monthly basis, if you're running a sprint, we're taking a breather right now. We're just taking a breather. Take the chart, I can pull it back. Right here is our resistance line. So that means anything above is good. Take a look here, and this would have been January. So sometime between January and February, you could have bought the stock at 68. You'd still own it. What's happening right now is if you've ever seen people run the Boston Marathon and take a regular normal person that's running a 10-minute mile average, well, they're going to have 12-minute miles. They're going to have a 9-minute mile. Right now, we're running the 9-minute mile.
Just so you know, that's probably the largest customer for everybody in this room.
Okay, well, thank you. I didn't know that. Hey, Jim, give me some money away. Buy him a drink on this
I
thing.
give him money all the time.
What does that mean? If you want to trade the stock, you can't trade the stock. If you're more like Mitchell and you want to buy and hold it for a long period of time, which if this stock, now the key thing is, with this stock, and they really give you the best thing, let's do a smart chart. What this is, the smart chart is, we're going to compare it versus the S&P 500. And we're doing the equal weighted index. Come on, work with me here. Work with me. There's your buy signal happened October 17th or November 17th of 2011. Right here. It's outperforming the S&P 500. Equal weighted index. Should have. It's outperforming the S&P 500. Equal weighted index. So it's good stock going? Sir.
I got that symbol for you.
Okay, let me write down. Let me do it, Duncan, real quick. Go ahead.
SSMGX.
Does that make sense to you? And the service is not done through me. It's actually done through a place called Dorsey Wright & Associates, which is based out of Richmond, Virginia, where I mentioned in the beginning the book. A guy named Thomas Dorsey actually started this company after reading the book by A.W. Cohen over a weekend. And it was a book from 1948. Tom's written 3 different books. The first edition is the best. The third edition is the worst because it gives you all of the things that have happened recently, and it becomes very boring after the first 22 pages. So if you can find the first edition in a library or somewhere, it's the best one to read. You can do this yourself.
What's the book called again?
It's called Point and Figure Charting by Thomas J. Dorsey. And he's not the guy who is in the big bands, and you kind of get confused on those parts. There's your stock, your mutual fund. Yeah. It's taking a breather right now. 57.6 with a hit there. May want to take a look at possibly making a move out because that's a sell signal. Now the first sell signal is usually false, as the first buy signal is. But if you have a majority of your portfolio in there, you may want to take a look at moving it away. And you know, I usually charge a lot of money for this. You're getting good trade, so take advantage of every single thing you can see here. IBM is actually, all the way back, buy signal here, broke through, we're broke, guess what you should have done? Sell it. Sell it. Now, understand, the first thing that I do though is I try to figure out, is outperforming the S&P 500 and the S&P equal weighted index and money market. Then we go to the chart on that. But if you take a look at IBM, IBM basically is in a trending pattern, and it's a sideways pattern. I probably would not own IBM right now. Duncan, yes sir, Mitchell. No, go ahead.
As you say, your philosophy and mine is different.
Yes.
Yours apparently works better than mine. But
Well, I wouldn't go that far.
I don't know.
You bought dinner last night.
But my philosophy is, as you said, I buy and I hold forever, and I look for dividends. But I'm going to ask you for one, which is the most obscure stock on the New York Stock.
Let's see if you know the symbol?
Of course I know.
Okay. Shoot it to me. Then I'll get back to you.
SB.
That's me?
SB.
Safe Bulkers Inc.
Right.
They are in transportation, non-air. Stock is actually, believe it or not, in an uptrend. Let me flip to this side. The way we see it in an uptrend is it's above its resistance line. This is a bullet or a bearish resistance line is what it's called. The bull and the bear, and I don't want to get into all that differences for you, but it's above the resistance line. It is actually on a sell signal, but it's taking a breather. Possibly could see it make a turnaround on that. These on the side give you the strength of where it is. It's right in the middle. It's not at the bottom of the, it's not down at the bottom of the monthly chart as it flows through. I mean, there's other things in this. I'm giving you just a thumbnail area. You may see it turn around. Could possibly hold it down to 4.5 if you so chose to give it room to make a movement. A lot of people trade on the first sell signal or the first buy signal. If you do that, you're making somebody a lot of commission money, number one, which is always good. But I don't work on commission, we work on fees. And we want the portfolio to grow in value. If you're holding this stock, I would continue to hold it right now. Here you were above, broke through at 6. You could have sold it at, where it was 6.5. Turn around, rebought it back. But I would hold that stock right now. That's a hold.
I've owned this for a long time.
Yeah, but it's old. So what I would do, this is one, not to get too complicated, this is a great one that if they had call options against it, you could sell what's called an out-of-the-money call option and continue to bring in premium. It's just like bringing in dividends.
It has dividends.
Yeah, but I'm saying you can sell an out-of-the-money call option and continue to bring money in.
When you're back at the $3 level.
Back here?
That's when you bought.
Yeah. Smart move. Judy's a smart lady. You better hang on for 50 years, my friend.
Anyway.
SCCO.
SCCO. I'm going to come back to you, Duncan. Keep that there, okay? I didn't forget about you. Wouldn't own it. That's simple. Wouldn't own it. Main reason is you were in an uptrend here. You were in an uptrend here. Had a sell signal at 33. Another sell signal happened here at 30. Another sell signal happened at 25. Trading below the bullish resistance line. Wouldn't own the stock. Come back to that. Duncan, I promise you.
The resistance line is up. Is that a percentage below?
Right. What we do with the resistance line is just done on a 45-degree angle straight across. So when you have bottom sell signal here, when it actually stops going through the floor, you just draw a 45-degree angle. In the same way on the top. They are like brick walls. It will bounce up against it, come back down. Bounce up against it, come back down. When it breaks through, you jump on that. You jump on that horse immediately. What was the next one? PTRA. Hopefully this is beneficial to everybody here. And then I'm going to show you one last thing. We're done. Would not own the stock. Go all the way up here at the 7.5. Knocking down, what, $1.75 is where it hit through the floor. Actually, you would have broke through here, broke through here. Wouldn't own the stock. Here's the neatest part. When we do these things, and I talked about the 401ks.
Can you do one more before you get off that?
What's that?
Can you do one more before you get off that? Just real
Yeah,
quick.
I'm still on this site. I'll come right back to it, but I want to hit this part real quick for you. And we do these matrices all over the world. It doesn't matter where you are, all over the world, we do these matrices. Come on, computer, work with me. And I'm sure you guys didn't expect that, this coming up like this. This is actually, I mentioned to you the gentleman that called me from Texas. This is his wife's 401k account. That's the matrix that we showed to her. And where she owned the Dodge and Cox fund, which is way down here, number 15. Very respectable fund. We now have her in the top 5. She's outperforming everything. Dodge and Cox is going well, is outperforming the S&P equal weighted index, but we're able to take her up to the top here and put her into 5 different areas. These are the things that we do with 401k plans. Everybody who has a 401k plan should be utilizing a service such as this that we offer to folks. And it works. It works. It is the fastest growing part of our business. And if you're working with a major New York Stock Exchange firm, such as, and I got to remember who they are, Wells Fargo, that is out there, which used to be Everett Securities, good old Payne Weber, E.F. Hutton, who used to be, which is actually where I started my career. If you take a look at any of these major brokerage firms, their advisor probably has never asked about your 401k plan. And if he does, he looks at it and goes, you need to use the asset allocation idea because he doesn't get paid on it. We can help you with that idea.
What do you mean he doesn't get paid on it?
He doesn't get paid. He can't get paid because he's enforced by what's called FINRA. He can't take a check from you as an advisory fee on that. It's against the rules.
You pay on the product that you choose, no?
Well, they do in a roundabout way. But say you're working with an individual advisor at Wells Fargo.
Yeah.
He won't look at your 401k plan. And if he does, he's not charging you to do it. So if you're not being paid, how much interest are you really going to keep track of that? Go ahead, Kurt.
The way that they ask you about the 401k in your initial sign-up, where they ask you where you're at, what's your age at, what your interests are, what level of aggressiveness versus conservative. Compare your service fees and performance versus what maybe most of us are given as options. For example, we have Insperity, which is our agent staff or paychecks, or something like that. And the firm that they use is Co-Invest.
Right.
And they charge you a percentage.
Right. What our percentage is anywhere from 3/4 to 1.5%. It's based upon the average on the asset value on a quarterly basis. So let's say January 1st you earn $100,000. We're going to charge you 3/4 to 1% if you make the changes in the portfolio. We're going to charge you 1.5% if I went and I make the changes in your portfolio. The difference for that is because I have to actually put the password in, and I have to go and make all of the different changes. I signed in your account.
3/4 to 1%. I just do the data.
If you do the data entry on your 3/4 to 1%. It's 3/4, and you can send me a check. We can do it through Visa, we can do it through American Express, we can do it through PayPal. If you happen to be with Fidelity or with one of the big,
How often would you see us making those changes?
that all is dictated by the market. It's all dictated by the market. When these relative strength changes happen, they are 18 to 24 months. Give you an example with this. She actually owns 30 different options. We're going to hold these top 5 until one of them hits down to number 10. Then we're going to kick that one out and buy the next one that we do not own. And it just goes into the portfolio. If money market all of a sudden runs up here, we're going to get in there. Changes don't happen often. It doesn't happen often. We run the calculations daily because we never know when the change is going to happen. Because as I mentioned earlier, we don't know where the market's going. Nobody does. And you take all your options. To give you an example, how are we going to outperform them? Send me your options on what you have available. Then, let's take and we'll go back. You tell me what time frame you want to use. You want to use a year, you want to use 2, you want to use 3, you want to use 5. You can take whatever time frame you want. Because I can go back with your options and say, this is when the change happened. This is the change we would have made. It's not indicative of what's going to happen in the future because I do not know. But I can show you this is where you should have been.
That's where you should have started this discussion.
Well, I have to give you the floor on where we're talking because none of this would make any sense for you without the beginning part, which I went through quick.
Say you're in an IRA.
Can do the same.
It's a self-managed IRA.
Self-managed IRA, we're doing the
And then
401.
index funds.
Yeah, well, what we would use is that dolly system.
Okay.
And then we would look at what sectors are the best sectors to own, and then we drill down. We can continue to drill down as far as you want. We have bought securities in Indonesia that we don't even know what the hell they are. And it doesn't matter. It doesn't matter. It may sound straight, but it doesn't. I mean, you have the guys that sit there and tell you every single thing right down to the CEO and who he is and who he's married to. I don't care. And when you sit down and do a financial plan, I'm going to give you the greatest financial plan. I'm going to charge everybody in here absolutely nothing. You want the greatest financial plan you've ever had? Buy a stock that goes up. We're done on time, but if I can go, keep going. Anybody needs anything, let us know. Shoot us your cards if you want any extra.